Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guests are Amanda Hahn and Matt MacFarland from Keystone CPAs, and they're tax strategists who specialize in helping people use real estate to save massive amounts in taxes and keep their hard-earned money, which is one of my favorite topics, So thank you guys for being on the show today. How are you guys doing?
Doing great. Thanks for having us, Kent.
Yeah, we're always happy to talk to people who love taxes. So excited to be here.
Well, I love taxes. I don't love taxes. I love being creative about taxes. And it's one of my favorite parts of real estate. I love the quote that, it's easier to keep the money you've already earned than to make more money. So let's all try to keep what we've earned, right? And so excited to talk with you guys today. Excited to really dig into specifically like tax strategies that can benefit passive investors, right? I think we can debunk some myths. You guys can highlight some really good approaches. And so, but before we dig in on all of that, why don't you tell us a little more about who you both are and how you got to be where you are today?
Yeah, well, thanks again for having us. It's great to be here. I'm Matt MacFarland. This is Amanda Hahn. We are married to each other. So in case I start dropping any some bad jokes about working with your spouse or something, don't get offended. But our firm is Keystone CPA. We're based in Orange County, California. We work with real estate investors all over the country. Some of them are just getting started in real estate, and it runs the gamut to people doing full-blown real estate and everywhere in between. We got our start at one of the big four accounting firms. I was in the private client advisor group, got exposed to real estate. She was kind of working in the real estate partnership group, I guess, for lack of a better term. So.
Yeah. So we started out on our own when we decided to invest in real estate personally and started meeting real estate investors at local events. And that was the first time we realized that a lot of the strategies that our clients at the big accounting firms were using were not being utilized or made available to everyday investors. So that's what sort of started our passion. And we love being on podcasts like this, where we can share best practices on how to actually use real estate to not just build wealth, but also shelter taxes. And like you said, Kent, debunking a lot of the myths around how you can actually control tax savings, even if you are a passive investor in real estate.
Yeah, very cool. And I think we're going to have a ton to unpack. So how did you guys, how did you start investing in real estate, or what was it from your background being experts in tax strategies that took you into real estate and said, wow, this is the asset we want to be in?
Well, I think I could talk about my aha moment. So when I was working at that big four accounting firm, I was probably 25 years old, a couple years into my career. I was reviewing a gentleman's tax return who was in his 60s, and he was retired, and all he had was real estate. And it was clear from looking at his tax return that he was not paying any taxes, but making over six figures in cash flow from his rental real estate. And that's kind of when the light bulb went off, like, there's something here. And so we naturally kind of gravitated towards real estate because of what we liked, what we understood. Amanda grew up in a real estate family.
What's really interesting is I'm the third generation of real estate investors in my family. So my grandparents invested in real estate. My parents dabbled in real estate. And I always grew up thinking I don't want to do real estate. And the reason was because I grew up in the same community where my grandparents owned the whole condo units. So they were very hands-on. And it just wasn't something for me. I didn't want to be a very hands-on landlord. So I decided that I didn't want to do real estate. I would help people with real estate taxes, but it was just not something for me until Matt convinced me that we needed real estate for passive income as a second source of income. So that's what got us to jump in and haven't looked back since.
Yeah. And Matt, I think you said something that really hit me, and I'm sure our audience. You have a guy, you're looking at his tax return, right? And he's making six figures in income, and he's not paying any taxes. So how could that be possible? Explain to people how that works.
That's the beauty of rental real estate. That's why we love it from a tax savings perspective. It's unlike any other asset class out there. For example, if somebody was to invest in stock, they go out and buy Google stock, they pay, $50,000 for the stock. They don't write off the cost of that stock right now. They don't even write that off until down the road when they sell the stock. But that's the difference with rental real estate. The IRS allows you to have this, we call it a paper write-off every year for depreciation expense. So you get to write off a portion of your building every year against the income you're making from that building, due to normal wear and tear, things like that. And so when you get that depreciation expense high enough, that's a way to shelter the cash flow from your properties. If your depreciation expense is more than the income of the property, sometimes you can use that to offset other income on your taxes. So there's a lot of opportunities out there from a tax savings perspective.
And that's the key, right? Is that depreciation and the fact that it's I think the only asset class that, appreciates in real life while it depreciates, on paper, as you said, right? And that's kind of the key to the value.
Well, and it's really important to point out that real estate investors are masters at using leverage. So very rarely do we buy an apartment building in all cash. And the beauty of the tax law is that depreciation starts with the purchase price of a building, irrespective of what your down payment is. So if I bought a multifamily, let's just say single family, I bought a single family home, it was $500,000. I calculate depreciation based on the building purchase of that $500,000, regardless of how much down payment I've made. So if you step back, what we're doing is we're taking a tax benefit for leveraged money, right? It was the bank's money, but I'm already taking depreciation on the entire purchase price of that specific building.
Yeah, that's a really interesting point, right? Because you may only have $100,000 of cash actually in the deal, right? But you bought a $500,000 building and now you're able to take it against that entire amount. So, how does that leverage, like what you're describing, is that leverage is really, I don't know, it's kind of exponentially increasing the amount of that depreciation that you're able to take, right? Against that initial investment. And it can become really powerful as you offset that, right?
Yeah. And especially now that the One Big Beautiful Bill has passed for 2025, the potential tax benefit from depreciation is even higher than what it used to be under old law. So currently, and also into the future, we expect to have 100% bonus depreciation. So if you look at the numbers, there are times where your first year depreciation tax benefit is higher than the down payment that you put in the form of cash. So pretty phenomenal. If I put $100,000 down payment, but maybe my first year depreciation is $150,000 in terms of, tax benefits. So pretty amazing. And this is sort of the game that the wealthy people play, right? How to use leverage, how to use the tax code to help you build wealth.
That's right. And I would venture to say that I think our wealthiest investors, there's a point where I notice in our investors where the wealthiest ones are actually investing for tax reasons, even more than the return. They like the return, but many are investing for the tax savings because they've structured their lives and businesses in ways where they're not only not paying taxes on the gains in their real estate investments, but they're also offsetting other types of investments as well. And so I definitely want to unpack that. But I don't want to lose what you said about the Big Beautiful Bill. I don't want to lose what you said about bonus depreciation as well, or accelerated depreciation. That probably doesn't mean a lot to people on the surface. So can you explain to our listeners, what is that bonus depreciation and how could you possibly have $150,000 in losses, if you've only invested $100,000, or for example, as you kind of take that and run with it?
Yeah. So with rental properties, we were talking about depreciation. There's typical ways you're going to depreciate a residential building, 27 and a half years, a commercial building, 39 years. But there's certain things in those buildings, sometimes furniture, appliances, fixtures, even light landscaping, fencing, shrubbery, things like that. There's things in those properties that can be depreciated over faster, shorter lives, 5 years, 15 years. But then with the one big beautiful bill bringing bonus depreciation back, all those 5 and 15-year assets now can be expensed basically right away in the first year. And so people might be buying properties and furnishing them and putting in $50,000, $75,000, $100,000 of furniture into a property. That's going to be an immediate expense. They might be buying a building and look at doing a kind of cost segregation / engineering study to look at the building and say, hey, I want to break out these components and depreciate certain things faster. The benefits of doing that have now more than doubled because of the one big beautiful bill. So there's a lot of opportunities out there. With our client base, we're expecting our clients to be very aggressive in buying more rental properties between now and year end, just to take advantage of more depreciation on their tax returns.
And you mentioned too, Kent, that a lot of investors you meet are investing in real estate, not just for the return, but also for tax savings. And it's really interesting because oftentimes one of the questions we pose to a client is, if you had the choice, would you rather pay that money to the IRS or would you rather invest it in an asset such as real estate? Because when you pay the tax, if those were my options, you pay the tax, the return on investment is a guaranteed zero, right? If you invested it in an asset class, in our example, if we're talking real estate, then you have a potential for, somewhat significant return through cash flow and appreciation. And that makes a whole lot of sense when you put it in that context.
Yeah, absolutely. And I think you're making a ton of sense to me. And hopefully everybody's kind of following this understanding. It's like, if you follow, like Tony Robbins has the quote, right? Success leaves clues. This is one of those things. It's like, why are all the richest people in the world investing in real estate? This is really the heart of it, right? Like, yes, it's a great return. Yes, it's, uncorrelated, allows you to diversify, but this tax piece is huge. When you think about, selling a stock and paying a 20% capital gains tax, right? If you're instead of paying that tax, if you're taking that money and you're further investing that money and you start to build that snowball and it starts to multiply, and you continue to do that, that snowball just grows and grows and grows and grows. It has this massive compounding effect. And that's how people get really wealthy with real estate.
For sure. I do think there is often a misconception about passive investments. So there are a lot of CPAs out there who tell clients that there's no tax benefit for you if you're a passive investor. If you still have a full-time job somewhere else, you're not doing real estate full-time, then all these benefits that you hear on the internet are not actually for you. When somebody says that to a client, what that means is they're taking actually just a tunnel vision look. And what they're saying is, because you're a higher income earner, your rental tax benefits do not offset taxes from your W-2 income because of certain laws in the tax code. But what they're not seeing is the fact that, like we just talked about, well, you've gotten more cash flow without paying more taxes. You've received appreciation on the real estate without having to pay any taxes currently. And I think everyone would agree if we say that if you've made more money than you did last year, but you didn't have to pay more taxes on the money you generated, that is certainly a form of taxes saved.
Absolutely. I think that's a really good point. And yeah, I mean, even if you can't offset, which I do want to kind of visit that as we talk about this too, like kind of what you can and can't, and like what are some of these myths. But yeah, your idea of, that's right. I mean, on your money coming in, right, that gain is being offset and you're continuing to, as you said, just make more money while not paying more taxes. I mean, that absolutely is a win, right? And I think that, I mean, I don't know who wouldn't see it that way, right? So I think it's a great perspective. So as we talk about this, because I think this is a great way to go, is, I know you guys have strategies for, as a real estate investor or somebody who's maybe starting to invest in real estate, how they can really maximize their tax gains. Like, walk us through some of these strategies, these core strategies that you set out for your clients or help them set up so that our folks can be smart and they can, as they start this journey, they can really maximize their tax savings.
Yeah, a good place to start would be actually looking at a investor who's maybe making $100,000 or less. I think that gets overlooked a lot when we start talking about advanced tax strategies, but we don't want to forget those people who are kind of, let's just call them getting started in real estate. So maybe you're somebody that's single, you've got a job, you're making $80,000, $90,000, $95,000 a year. we've had clients in that situation where they bought one rental property and able to generate $25,000 of depreciation expense on their rental that becomes a net loss, and they can use it to offset their W-2 income because they make less than $100,000. So for somebody in that situation, you're making close to 100 grand and you can wipe out 25% of your taxable income. I mean, that's a game changer for somebody, let's say in their 20s getting started and really starting to, hey, I really like this real estate bug. I've got it. I want to do more. So I think that gets overlooked a lot, but there's a really powerful piece there when somebody's in that right situation.
And for people who are of higher income, if you are a real estate investor yourself, meaning you own rental real estate, and to the extent you can qualify as a real estate professional for tax purposes, then what a lot of people don't know is that if I'm a real estate professional and I invest passively in syndications, let's say a motel, a hotel, an apartment deal, if I invest passively in an apartment deal, I could potentially utilize those tax benefits, even though I'm purely passive in the multifamily syndication. I could potentially use those losses, combine it with my own rental losses, and offset all different types of income. And that includes retirement income or income from a business, or if I had a working spouse who's generating higher income, or even, capital gains from stocks or crypto. So that's the beauty of real estate, that if you're planning correctly, then we're looking at not just using it to generate tax-free income through passive investing, but also how do we take it a step further and try to reduce other income sources that we might have as well. Now, it's probably not going to be super easy for everyone involved, but with tax planning, these are things that are possibilities that we work with clients on all the time. For some people, you can do it this year. For others, it's maybe a 2 to 5 year plan to achieve that goal.
And that's the holy grail, right? Is when you can start offsetting using those great deductions we talked about, right? Or those, that depreciation expense, you're maximizing it by using, cost segregation study, you're accelerating that depreciation, and then you're taking that and you're offsetting other gains. That's really the holy grail. And it's not something that can be easily explained on a podcast. I'm sure the whole strategy, you got to talk to the professional, but the whole point is, as you're starting in real estate, it's important to keep your tax advisor involved. And it's important to have a tax advisor who, doesn't have that narrow vision, right? And who understands the big picture and is able to find those more advanced strategies that you guys are outlining, right?
Yeah. And we do, in the tax world, we talk a lot about active income versus passive income. And I think another commonly made tax mistake is people assume that if I get tax benefits from a real estate syndication, I can only offset income from real estate. If I'm passive in real estate, I'm not one of the general partners. And the truth is, you can actually use rental tax losses to offset all types of passive income, even if it's not specific to real estate. And we have some really great examples with clients who just have other passive income, like doctors.
So explain what constitutes passive income for folks.
It's really a tax terminology, but essentially it means that you've invested in something, an asset class that you are not really involved in. It's just generating income. You're kind of sitting on the side, collecting a check, for lack of a better term. The IRS defines rental properties as default as being passive activities unless you can show that you rise to the level of like a real estate professional. But maybe you're investing in other businesses. You invest in a real estate syndication apartment building. Obviously, you're a money investor. You're passive in that deal because you're not making any decisions. Maybe you've invested in your friend started a car wash. They syndicated a couple car washes and you're a money investor. That's a passive activity to you.
Yeah, the example to utilize to demonstrate would be, let's say you're a doctor, you earn income from being a physician, whether that's W-2 or medical practice, but at the same time, you've invested your money in other people's businesses. So let's say I'm a primary home doctor. I've also invested in an X-ray business or medical imaging business or a dialysis center where, like Matt said, I'm not working in that business. I'm just an investor. So this is a fact pattern we see quite a bit. You're a high income professional. You have these investments in other businesses that are generating high cash flow, high taxable income. Well, guess what? if I also happen to invest in a real estate syndication that's kicking off passive losses, I can use my real estate losses to offset the income from a passive medical investment as well. This is an area of opportunity we see missed all the time. And you're able to achieve it even if you are not doing anything with respect to real estate, right? You're purely passive in both business lines.
We have a great story. We had a client come to us a couple of years ago. He was this exact scenario. He was a doctor, but he owned a part of a surgery center that he worked at one day a month, didn't make any decisions for the business, but on his return, he was making 7 figures of passive income from the surgery center. It was very highly profitable, but he came to us with this idea. Hey, I listened to you on a podcast. I hear about real estate professional. I want to get full blown into real estate. It's like, well, let's hit the brakes here. You don't need to be a real estate professional. Let's just go buy enough real estate, invest in enough syndications that you're generating paper losses from depreciation that can offset this $1 million of income. Because again, we don't need to offset your W-2. If we can offset $1 million of income, that's a home run for you, right? So I think it's all going to depend on this person's situation. And that's, to your point, is it's really important to have that open line of communication with your tax person so that you can, they can understand what are your goals, what are you trying to achieve, what are you trying to invest in, and then go from there and create a strategy that works for you.
Yeah. And I love that story because that really just comes back to what I said. And a lot of our richest, our most wealthy investors are doing it, for tax reasons, alongside the returns, right? Because many of the wealthiest folks I know have multiple streams of income. And, they know that they can offset these and they can do a lot of these strategies, and they come to us because we're maximizing the amount of depreciation they're getting through these different studies that can be done, which is just gravy on top of that overall return that we actually get from the real estate.
And one of the benefits of being a passive investor too is not only do you not have to worry about the day-to-day operations of owning a big multifamily, but you also don't have to worry about the tax strategies associated with that investment either, right? So as the sponsor group is going to maximize the write-offs on that deal. They're going to do the accelerated depreciation, cost segregation. And as an investor, you get everything beautifully wrapped up with a bow tie on it in a K1 when it's tax time. And you just take that number.
Does it come with a bow tie?
It's a bow tie, a bow. And you get to take that number and, be able to utilize it however that best fits your personal scenario. So from a passive investor's perspective, the planning to do with your CPA is what are the things that I should be doing as an investor to make sure I'm able to optimize that K1 loss that's coming to me. I personally don't have to worry about how that loss is created on the tax return.
That's right. It's the magic of being passive. Well, one more thing I wanted to hit on as we're talking. One other thing I've heard you guys talk about is, I think a lot of people don't realize, you can use retirement money to invest in real estate. So we're talking about, using your IRA or even maybe using your 401k to be able to invest. Can you just unpack that a little bit for folks and kind of help people understand what they can do, how they can, any myths around that?
Absolutely. And you hit the nail on the head. There's a lot of people out there still that don't realize that they can invest their retirement money directly into real estate. A lot of people, for whatever reason, still think they can only use their retirement money to invest in the standard stuff, stocks, bonds, mutual funds. But it's been around for years. Obviously, financial planners don't necessarily want you to know about it. But what we talk to our clients about is, hey, you understand real estate. You get it. You know how to derive value from it, make money on it. Would you rather use your retirement money to invest in something you understand or leave it to somebody else and invest in something else? And so when clients think about it like that, they're like, hey, that makes a lot of sense. And so they, maybe they'll move all their money to real estate in the retirement account. Maybe they'll move some of it, right? But yeah, there's a lot of things that, generally speaking, there's a lot of things you can invest in. Your rental properties, syndications, you can do notes. That's a great one for a retirement account. So your retirement account is lending money on somebody else's real estate deal. Why we love that in a retirement account, because if you do that with your personal money, that's going to be interest income tax at your highest marginal tax rate, ordinary income on your personal return. You do it in your retirement account, that's tax deferred money until 20, 30, 40 years down the road when you retire, right?
Yeah. And it's really the steps to using retirement money for real estate is actually not very complicated. The first thing you do is you have to roll your money over. So like Matt said, traditional brokerage accounts, Fidelities, these Wells Fargos, they won't allow you to do true real estate investment. And so what you do is you find a self-directed custodian, then you can roll your current IRA money over, or an old work 401k, roll that over to a self-directed account. Once it's in the account, then you can just start shopping for assets, right? Whether it's syndications or notes or whatever it is. And it's a tax-free or tax-neutral way to just change your asset class. A lot of financial investors, financial advisors oftentimes will say, oh, you can't do that. Can't move into real estate. You're going to have to pay taxes and penalties. But what they're referring to is liquidating a retirement account in cash and then invest, versus the more strategic way to do it is to keep in the retirement account. We're simply changing custodians so that we're able to access more asset classes like real estate syndications.
Yeah. And that was really a huge epiphany for me. Right. When I learned that I could, unlock retirement funds I had from back when I used to have a W-2 job. Right. And I didn't have to just continue to pour that into some like ambiguous fund that said, 2040 retirement fund. Right. And I could actually put that into and choose what I was really investing in. And the same thing for a lot of our investors. A lot of our investors they'll put cash into the deals, but they'll also invest, maybe half through their retirement accounts, and they'll kind of blend that to be able to get, some more exposure. And, so I think it's just something that as I talk to investors every day, find that people just aren't aware of how to do it. And it's exactly because of what you said. The main financial advisors who are funding most of the marketing and the shows and things that we watch, and who work with all the employers, don't want you to know, because if you do that, right, you're taking money out of their pocket in fees. Right. It's not a complicated thing to understand. It's an easy conflict of interest to understand. And it's why we don't hear about it a lot, but really important. And so you can find like a self-directed IRA. There's a lot of groups online. We have a group that we partner with to make it very easy for investors. We've streamlined the workflow because we know how important that is. But yeah, I wanted to just unpack that for a minute because I feel like that's such an important piece for people. And real estate, like you said, we spent a lot of time talking about the benefits of depreciation and the tax savings. And when you invest with your retirement account, you don't necessarily get all of those pieces of it, but you also shelter, a lot of these big gains, right? And so there's still quite a bit of value in investing in your retirement account.
Yeah, it's interesting because there are a lot of CPAs who say don't ever use retirement money for real estate because you lose out on the tax benefits. What is flawed with that statement, though, is just as you said, Kent, when I use retirement money for real estate investing, it is already either tax deferred or tax free. So I'm already not paying taxes on that currently. So if I'm not paying taxes on something, why do I care about depreciation, right? If I'm not already paying taxes on it. But yes, what's really interesting, I just looked the other day, there's over $45 trillion as of Q1 2025 in retirement accounts. And you're exactly right. A lot of people become somewhat complacent about retirement money because it sort of leaves your paycheck every month. It goes to this account. We're not able to use it or we're not supposed to use it and touch it. So we sort of forget about what it's doing. We don't monitor the returns. A lot of people actually don't even know how much money is in the retirement account to a somewhat good degree of ballparking. So really important when you're thinking about wealth building and investing to also take a look at your retirement, seeing how it's doing. And if it's not doing what you want it to be, then consider alternative investments such as real estate, syndications, and notes.
I think that's well said. You're talking about taking control of your financial future and being an active participant in your retirement and your future and your wealth building, and not just leaving it up to chance. So really appreciate the knowledge you guys brought today. I think some what I consider fascinating topics. I know we give tax a hard time, but man, I like making money, and so I like understanding taxes, right? We all should. Before I let you guys go, I got a few questions I want to ask you, kind of our lightning round, our keys to success round, 4 questions. The first one, arguably the hardest, and I admit I didn't give you guys a big heads up on this. And so the first one is, if you were going to invest in a syndication deal, right? You're a passive investor. You don't know anything about the deal. You don't know anything about the sponsor. You don't know what's going on. You can ask one question to them. What's the one question you're going to ask them?
For me, the question
you
for
can
the
both
sponsor,
answer.
okay. I mean, we can have 2 answers or one. The question for the sponsor would be, tell me about a time when you failed on an investment.
I like it. I think for me, we always joke when we talk to people we meet, investors. I think I would ask them, is your name associated with fraud online? Something like that. So, we always, people don't think about that, but if you're going to talk to people, go search, John Smith and fraud or SEC if you're talking to a sponsor, because you might learn something interesting about that person that you might want to know.
Absolutely. Digging into that background. It's always good to do a background check, right? Next question is, what are you most proud of in your career?
Gosh, I think that the unique ability to explain taxes to the everyday person and do so in a way where it's understandable and allows them to take action on what they hear.
I think for me, it was being able to take that leap from being a W-2 to working for yourself, being a business owner, growing a firm. It took a lot longer than we thought it would, but we've had success at it, and just being able to make that leap, because I think a lot of people can't get over that hurdle, good or bad. But for us, it was it was the right decision, obviously.
Yeah, it's fantastic, and something to really be proud of. It is a big leap to take, right? But I'm sure you're like me, like you said. I would never turn back. What book should everybody read?
Well, we wrote a book called Tax Strategies for the Savvy Real Estate Investor. So
Fantastic.
My shameless plug will be, that's a pretty good book. It is a compilation of no tax codes, not a lot of numbers, but a compilation of a lot of client stories on what could happen if you implement tax strategy in real estate investing successfully, but also what could happen if you do things incorrectly.
I think for me, the one that stands out was probably one of the earliest ones I ever read was Rich Dad, Poor Dad. I mean, that's a legacy book. I'm sure a lot of people have already read it, but if somebody hasn't, it will change your frame of mind and how you go and think about money. So highly recommend that for those who haven't read it.
Absolutely. Both excellent books. We'll make sure both of those are linked below in the notes so folks can go access them and check them out. And then last question, what is each of your number one key to success?
For me, I'm a quick start. I feel like that is my key to success, is I'm able to move quickly from idea start to implementation and sort of fix things along the way as we go.
For me, it's get a good team in place, whether that's, your team of advisors, maybe that's an internal team. Find people that have strengths that you don't have and leverage those as much as you can. That'll pay off huge dividends as you move along in your investing career.
Fantastic advice, guys. Matt and Amanda, thank you so much for coming on the show today. If folks want to reach out to you, they want to know about Keystone CPAs and how you guys can help them out, how can they reach you?
Yeah, the best place to find us is our website, which is KeystoneCPA.com. We have a lot of information on there, a lot of free resources. Maybe you heard some terms today that you're not quite sure what that means. You can go dive deep into our website. We have a lot of stuff there.
Yeah, and if you're looking for daily brief tax tips, best place to find me is on Instagram as Amanda Hahn CPA.
Awesome. Again, we'll make sure it's all listed below. Everybody check it out. Thank you both for coming on the show today. And with that, have a great rest of your day.